Hey, everybody, welcome in. Thank you for joining. Happy Monday. It is a very strange world in which we live in right now. We're seeing riots in places like Sri Lanka, run on Chinese banks, a huge run on all the CFI institutions across the world. We're seeing now apparent rationing of energy in Germany, per the Financial Times, not fake news. Crazy things are happening all around the world. But let's dig in. I did a video yesterday, touched on some macro stuff, and it alarmed some people, but they want to know more. And this is a report from Pantera that came out about a week ago, but nobody was talking about it. But I want to bring it up because it has some very pertinent information. I will talk about what I think is worthy to share with you all, and also where I disagree with the report. So let's jump in. Whoops. I had the wrong thing on. Hold on a second. Hopefully this works. Yes. And of course, as usual, this is never financial advice. I want to make sure everything's working fine. Yes, it is. Good. So the Pantera report, this is maybe a little bit of an overlooked report by many, but I saw it a week ago and I thought many people would be talking about it. Nobody's talking about it at all. I searched YouTube, couldn't find anything. But basically it talks about how the markets are in trouble, the policy errors done by the Fed. We look into things like inflation. Everybody is now obsessed with what the Fed is going to do after the CPI print on Wednesday and where we'll go from here. And again, Pantera is a crypto fund and they obsess about macro. So as you guys, as crypto and investors, it's very, very important to have a focus on macro. So first of all, this is not Pantera Capital. There is apparently another Pantera, but this is not those guys. So Pantera Capital is the first institutional asset manager focused exclusively on blockchain technology. It was founded by Dan Moorhead, I think, way back in the 2000s sometime. He's a former Tiger management guy, and it's the largest crypto hedge fund in the world. They know the stuff and they put out some really, really good reports. So thank you to Dan and the team for doing this. So they talk in this report about the two worst policy mistakes ever. First one they just realized, and the second one they don't understand. And Dan refers to it as the worst self-inflicted disaster he's ever seen in 35 plus years. And we'll talk about these two separate mistakes and what it means for the future of us going forward. Also, the important thing is they don't seem to understand the second one very well. The first one, of course, being inflation. But let's jump in and talk about the first mistake. One is basically zero or next to zero Fed funds rate combined at the same time with double-digit inflation. And we'll dig into what double-digit inflation looks like and why they believe we actually have double-digit inflation. Second of all, proof that CPI is fake. There is a concept, a part of the CPI that came into play, I think, in the 80s. It's called Owner's Equivalent Rent, or OER. And that is basically the owner's equivalent of owning a house based in rent. And you can see the blue line here is the owner's equivalent rent change year over year. And you can see it doesn't change much at all. And the white is the Case-Shiller index, which is the home price index. As you can see, never the twain shall meet, which means there's a problem with one of them. But let's dig in. So what is OER, owner's equivalent rent? So yeah, there's the number. In 82, the CPI changed to measure housing inflation in a very slow-moving index called owner's equivalent rent. Slow-moving is the operative word here. And it's theoretically the amount of property an owner would have to pay to be equivalent to the cost of ownership. And the OER component of the CPI is up only 5% year over year. And anybody trying to rent or buy a house or apartment knows that it is not reflective of reality. And that's a key part of their crux. They're just pulling out one aspect of CPI and showing how fake the CPI actually is. We've been talking about that for a long time here on this channel. Now, the real inflation people experience is obviously much higher. The Case-Shiller went up over 20.6% year over year. The OER it makes up 23.8% of CPI, but it hasn't been adjusted upwards. And the OER was reported, if it was true, it would be reported around 20.6%, and that would put the true CPI up around 12.54%, not 8.6% or 8.8%. But we'll talk more about that in a minute too. And trust me, there's a point to all this. Now, the FFR, this is the Fed funds rate. And as you know, the Fed preferred to look at core inflation. And I think the core inflation will be a big topic of discussion on Wednesday. That is the CPI less energy and food. So let's look at this chart here. This is the year-over-year core CPI. And as you can see, it was up 6% in May, and that's the highest since October 82. And using the Case-Shiller in place of the OER, true CPI would have been up 11%, which is 4.9 percentage points higher than the core CPI. And that's higher than any time since 1980. And eventually, the owner's equivalent rent should catch up to reality, but it's very, very slow moving, as we mentioned before. So let's talk about the policy gap. This is an interesting chart, which I thought about, but never thought about representing on a chart. So I'm glad these guys did. So here, the policy gap is, obviously the Fed policy is a stimulatory, as at any point in history, including the dark days of the 1970s. And the real Fed funds, the Fed funds rate less the true core inflation, that is the white line, is as loose as it's ever been at minus 9.4%. And at the same time, the inflation, the gold line, is higher than most times in history. And you add the minus 9.4%, or you calculate the delta between the minus 9.4% and the Fed funds rate to compare the true core CPI, and you get 20.3%. And this is the problem. This is why something is going to break, because this policy gap is at extreme levels. So let's talk about one of the things that happened. And Pantera pointed this out very well. And they talked about the fact that in the previous 95 years before the year, I think, 2019, 2020, they never, ever bought bonds. It was basically free market actors, banks, mutual funds, pension plans, insurance companies. They are the people that issued money to lend out to enterprises or people looking for mortgages, and even the federal government at appropriate rates. But the Fed did not manipulate the bond market at all. But when the Fed got into the mortgage lending business, they really went for it. And they caused a huge part of this bubble. You can see before it was always zero, and then all of a sudden 3.1 trillion was put out by the Fed. And what that did was it crowded out traditional lenders. But how did they do that? Is they blew up their balance sheet. This is the Fed balance sheet, just coming off 9 trillion, because they are doing a little bit of QT. But that balance sheet expansion is very visible from this chart here. Let's talk about Fed hikes. This is one of the areas where I disagree with Pantera a little bit, and I'll talk more about why in a minute. But here, the 10-year Treasury yield has been up 185 basis points in a short window of time. And without manipulation, Pantera believes Treasury yields will likely go to 5%, remember, without manipulation. But I think the 10-year tells us where we are going, and that will be somewhere under 3.5%. And short term, they can do whatever they want with rates, but medium term, like 3 to 6 months or longer, they have to be very, very careful, because there's simply too much debt in the system that I spoke about yesterday. And unwinding that debt will be very, very hard. So Pantera see a potential going to 5%. I don't think that's possible. Now, when does Pantera believe the Fed will stop, i.e. pivot? And this is something I've also been talking about quite a lot lately. They believe 2 of these 4 things have to happen for the Fed to stop hiking rates or pivot. So first of all is housing inflation goes negative. I spoke on Friday on Ben's channel on DCA about the math behind how I believe real estate will fall 20%. And I do believe that will happen. So housing inflation will go negative. So that's a green. That's going to happen. Unemployment rate goes to 2%. I also believe, or goes up by 2%. So if it's at just 3.5% now, it'll go to 5.5%. And then they'll be happy. And the other 2 are almost impossible. I.e., I do not believe core CPI will get near 2.5%. And I also believe it's almost impossible for the Fed to unwind the majority of their mortgage manipulation. That is going to be a huge problem. So let's see. Now the question is something going to break? And the answer is, I think so, yes. GDP will continue to fall, spinning us into a bad recession. The credit markets are already shaky. The stories of companies like really big brands now issuing corporate treasuries at 8 and 10%. And you have Michael Saylor, who a little over a year ago was borrowing money at 0%. That's how shaky the credit markets have become, everybody. And it's just staggering. Not only mortgage interest, but also credit markets in general. Now, the corporate bond markets are very distressed. A lot of companies, including big names that you know very well, I won't mention any in case anybody gets upset, but they're having a hard time. They're struggling to raise money. So the question is something going to blow up? We'll see. So this chart is the Fed pivot indicator that I did not know about until today. So a big thank you to Jay at Julizzle, hope I got that right, on Twitter. And he retweeted something from the Happy Hawaiian. And this is a perfect chart that says clearly what I've been struggling to express for months now with numbers. And pictures do tell 1,000 numbers. That's a new phrase. Not 1,000 words, but now 1,000 numbers. And as the Fed gears up for 75 basis points hike soon, they could be knowingly blowing up the system. And this is because of this chart here. So you'll see it goes back in time. It goes back to March 89 when the Fed hiking cycle ended, April 1995, June 2000, July 2006, January 2019. And it obviously after a hike, rates go down, etc. But this yellow line is a function of the average of the 5-year yield, the Fed funds rate multiplied by the national debt. And this is exactly what I've been struggling to say is there's so much debt in the system now, it's hard for them to keep jacking rates. It is really hard and it'll break something. If that yellow line goes outside of that little vortex, we could be in trouble. But will the Fed break it? Well, according to Pantera, they've made 2 huge policy errors. This could be the third. So we'll see. Now, talking about crypto for a minute, Pantera did talk about TVL, locked-in DeFi protocols, and they have been very impressed with how DeFi protocols have done their jobs better than centralized crypto finance firms because they're all mathematically, algorithmically based. And decentralized borrowing and lending protocols have been very orderly, with 1 or 2 little exceptions, of course, in case people go after me in the comments. But people are running for the hills on this heavy risk-off environment, and the amount of TVL locked in DeFi protocols is down at March 2021 levels. So it hasn't escaped entirely from what's happened. Let's talk about Dex Volume. Decentralized exchanges have also been running very smoothly. But monthly trading volume is also off again. We're back at June 2021 levels, even March, actually bang on March levels as well, just like TVL, which isn't surprising. Let's talk about drawdowns, another great slide from Pantera. Here you can see that crypto seems to be thought of as a long duration tech stock right now. So you can see you've got the big tech names, of course. The one that's holding up best is Tesla. Facebook is down 56% from its 2021 highs. Bitcoin 70%. Zoom 71%. Netflix 73%. Ethereum 76%. Block 76%. And Roku 81%. And there's some other names that are down even a lot worse than that. So it's interesting how Bitcoin and Ethereum are nestled right in the middle here of a lot of these big names that you all know. So let's talk about correlation as well. They looked at Bitcoin correlation to the S&P 500. Obviously, it hit an all-time high on the 7th of May, 2022 at 0.76. It's even more correlated to the NASDAQ 100. And there's been 6 times, I think, where the S&P has come way down and the Bitcoin price has been highly correlated, but only over those previous 6 times for the first 71 days, which is a very interesting finding. This time it's run a little longer and it's still correlated, but that could break. And remember, everything I started talking about at this video at the very beginning, everything's breaking all over the world at the same time. What's going to hold up? I don't know. But they seem to believe as well that the correlation could snap off. So let's talk about the historical drawdowns of Bitcoin. So Bitcoin is now, per this slide from Bitcoin Pro magazine, It is down 69.72%, call it 70% from the previous all-time highs. And with the peak of the drawdown reaching 71.86% on May 18th. So the question is, where do we go next? It's obvious the macro situation is god-awful, getting worse by the day, super ugly. But if you look at these historic bear market drawdowns in the past, you've got that 93% way back in 2012, 84.8% in 2015, 83.4% in 2018, 75.19% during the C19 blip, which doesn't really kind of count. And then you have where we are today. So we do have slightly higher lows, and the drawdowns are not as extreme as in the past. Now, I have pointed out this before, but not with this particular slide. So I hope they don't mind me adding the green line. So the question is now, what is Pantera doing now? They are a big hedge fund for crypto. So they said in their paper, they put a large portion of their assets into Bitcoin in late May. Remember, late May, Bitcoin was trading about 30,500, 31,000. And it's gone down a lot since then. In fact, looking at Bitcoin right now, I think it dipped just below 20K. Yeah, it is 19,996. So just a couple of dollars under 20,000. Now, what they're doing as well, what they believe is when the market starts to rebound, Bitcoin will continue to outperform and it's going to accelerate faster than many other assets out there. However, they said once it's very clear that the market has bottomed, then it will make sense to rotate out of Bitcoin back into higher risk, higher reward alts. So that's their strategy, which is super interesting. But it's interesting as well when you look at the Bitcoin dominance. People would have thought the Bitcoin dominance would have been a lot higher than it is right now, and it's not the case at all. People are still loading up on things other than Bitcoin and Ethereum, much more so than many expected. So my view on where we are with hikes and inflation is as follows. There's a lot of confusion out there as to where I stand. Things are ugly. I did talk about the fact that I do believe we are beyond peak inflation, but remember, the CPI number is looking at June compared to a year ago. So it's looking at what the situation was a year ago versus today. And that is why the number could be elevated. Many people expect it to be about 8.8% in June, which is 20 basis points higher than it was last time they measured it in May, which surprised everybody. Now, the core CPI, which is, again, pulling out energy, etc., this may be the bright star. And this is what the Fed have hinted at talking about. I think they're going to try flip the narrative and focus more on the core CPI as we go forward. Another key thing to note as well, I forgot to mention this, but since the start of 2021, the month-over-month CPI has printed above consensus forecast 11 times out of the last 12. Only once in August 2021 was it under expectation. So people are having a tough time measuring inflation. In fact, jump out again for a second. I think the White House spokesperson came out with a press release today saying it's going to be bad. So inflation could be bad for June, but they'll spin it in a way that we're beyond peak inflation, I believe, and they'll probably focus on core. So that's the Fed narrative there. Now, 75 basis points is factored in, about 75% chance of 75 basis points, 25% chance of 50 basis points. But remember, per my model, every 25 basis points pulls 77 billion out of GDP, out of the economy. And 77% is the debt to GDP tipping point. So I just thought it was funny that 25 basis points equals 77 billion and 77% is the debt to GDP tipping point. I just like to find patterns in numbers. And the market will rally if the inflation print is 8.7% or less. I believe, not financial advice. So with that, everybody, very, very, very important to think about Wednesday and what actually happens. That'll determine what will happen with the markets. And maybe the markets, they sold off hard today. Bitcoin selling off now and after US market times as well. A lot of great clouds ahead, but be prepared. If we start getting any sign of that pivot, any sign that inflation is under control, markets will rally. And that's when we need to be on the train. Other than that, harbor cash as much as you can right now. Thank you, everybody. Happy Monday. Sorry for being a bit late today. Busy day. And I'll talk to you all tomorrow for TA Tuesday. Thanks all. And thanks to all the mods as well out there.